continue the topic previously. For risk-free return, in order for it to become market meaningful, we need to look for the highest risk-free return in market. Usually, we can use the interest rates of treasury bonds. We think that treasury bonds issued by the central government of China is a risk-free securities. Its interest rate is guaranteed. In this way, we think the interest rate of treasury bond could be as the highest risk-free return in market. This is about risk-free return. Now, next, let's explain what is called risk premium. Now, let's have two comparisons. First, it's return, and then this is risk. Suppose here we have the risk-free return, and its corresponding level risk is 0. Suppose no risk means 0. Well, if we can have a higher return here, that means this part of return is the compensation brought by we take the risk here. So here is the risk level 0, and here, this part, we call them the additional risk. Right? So that's why we call it is a compensation. In this way, we call this risk premium. Okay. Risk premium refers to actually a return as a compensation brought by undertaking additional risk. So now you know it is actually a return, right? Additional return. Now let's go back to Sharpe ratio. This part is the risk compensation or risk premium. We use the actual return minus risk-free return. This is called risk-free return. We can also call this additional or extra return as well. Here, extra is based on risk-free return. In this way, we can also call risk-free return as normal return, while R minus RF as extra return. Right? So this is actual return. Then we use standard deviation as the risk level. Yeah. So the core idea of Sharpe ratio is to use risk premium divided by risk level described by standard deviation, right? So this means you undertake additional risk like this, which is above 0, right? And you have additional return. So the extra return divided by the extra risk. This is the core idea of Sharpe ratio. Right? Yeah. Well, some other scholars also borrow the core idea of Sharpe ratio, and they create many other ratios. The major difference between Sharpe ratio and some of the other ratios is the measurements of risk level. They use different measurements of risk level, such as we have Sortino ratio as well. They use LPSD, right? And we have some other ratios as well. Okay. Now let's look at other portfolio constructing strategies here. This time, we expect to employ Sharpe ratio and MPT, as well as MPT, to construct our better investment portfolios with higher return and lower risk. And in between them, I'd like to introduce two very interesting strategies. One is called MSR, another is called GMVS. It is tailored for different investors' risk premium tailoring for different risk premium, risk preference. Okay. Now let's look at these strategies first, and then I'll show you how to do this. Well, here we have our efficient set. So this is also called Markowitz efficient set. And we now know that the front line is called the efficient frontier, and the lower line is called the inefficient frontier, right? This is efficient frontier, and this is inefficient frontier. We only look for our investment portfolios on efficient frontier. Well, this time we expect to look for two featured portfolio strategies. One is called MSR, another is called GMVS. Let me explain what is MSR strategy and what is GMVS strategy. MSR strategy and GMVS strategy. MSR strategy, we look for a portfolio with highest Sharpe ratio. Means the extra return divided by extra risk. We look highest value of this. That means for given a specific level of risk, we look for the highest return. And given a specific level of return, we look for the lowest risk. This is also the two objectives of MPT as well. So this strategy will look for the highest Sharpe ratio, right? This also means maximum in Sharpe ratio. Right? MSR. While for GMVS, it's in the other end. It looks for the lowest risk. The GMVS means a global minimum volatility. It looks for the lowest risk. Now let's back to the slides and try to find out which one has the lowest risk. First, we can easily find out this portfolio. This is the risk axis, right? Risk. And this is return. Well, this point apparently has the lowest risk here. Well, it is not necessary to have the lowest return because the line is here. We do have some other portfolios which return is lower than this point. So this point is called GMVS points. So next time when you see GMVS point, it means the portfolio with definitely the lowest risk, but not necessarily the lowest return. Okay. It is a good choice usually for very conservative investors or for extremely conservative investors. Right? Well, let's find out MSR points. We find that MSR point here with the star, okay, the MSR points we have. This point we have the highest Sharpe ratio. Highest Sharpe ratio. Right? However, please be aware that MSR point is not necessarily at the rightmost or upper right point, not necessary. Sometimes it may be here. It depends on the shape of the efficient set, right? If the efficient set is this shape like this, it will be here rather than the upper rightmost. Well, this is based on the Monte Carlo simulation of 50,000 portfolios and based on the member stock in my portfolios. The observation period is from 2020 July 7th to 2021 July 7th. Okay. Made it this day. And let me explain this one. This one, we call that the color bar. Color bar. Okay. So this side, we have the lowest Sharpe ratio. Lowest Sharpe ratio. This end, we have the highest Sharpe ratio. So this color bar is actually indicating the Sharpe ratio. This goes higher and higher. And the color here is corresponding to here as well, right? Just look at this one. And the color here is here. So it helps us to identify the portfolios in the efficient set, which part of portfolios have the highest Sharpe ratio. The greener the portfolio, the higher the Sharpe ratio. And the redder of the color, the lower the Sharpe ratio. So this helps a lot. Well, this way Sharpe ratio goes up, right? And this way Sharpe ratio goes down. Well, this is about the points in based on Sharpe ratio to find a better investment portfolio here. GMVS indicating lowest return, lowest risk, sorry. Now let's look at the actual performance of MSR and GMVS compared to the previous strategies. Now we have the original portfolio, my portfolio here is the blue solid line, this one, my portfolio, which is the portfolio before optimization. And then we have the GMVS. This is the GMVS, right? And then we have the equal weight here. Equal weight here is, this is equal weight. We have the equal weight here. And then this is the MSR. This is the MSR. Now these are the dates. Suppose our investment starting point is 2020 July. And after 1 year, if we employ different portfolio strategies, our return is totally different. For example, if we use the GMVS strategy, our return would be here, about 50%. Still very good. If we still maintain our original portfolio, our return will be here. Suppose this is about 60%, okay, nearly 60%. if we use the equal weight strategy, our return would be here. I believe it is more about 85%. However, if we use MSR strategy, our return would be 175%. So what do you think? This proves that MSR strategy works pretty well, right? Of course, we can do some further analysis between return and risk. So this is our original portfolio. After optimization, we call this investment portfolio strategy optimization. Our return increases from 60% to 175%. So this is the power of the MSR strategy. And this is the success of MPT and Sharpe ratio. Okay, let's do some further analysis between risk and return among these strategies. Okay, let's look at this one. This is the portfolio. We have the MSR, we have the equal weight, we have OM cap, we have my portfolio. This is the original one before we have any optimizations. This is the GMVS. Okay, then we have a rank based on return. Well, of course, MSR ranked number 1 in terms of return, and GMVS ranked the last in terms of return. Highest. Okay, these rank are from high to low. Okay, then we have a rank of risk. So MSR has the highest risk, while GMVS has the lowest risk. Then let's look at the annualized return. So for MSR strategy, after we have 1 year investment, our annualized return is 2.2, and our annualized standard deviation is 0.5. 0.5. If we take this my portfolio as the original one as a base here. Okay, compared to the original portfolio, MSR strategy, they escalate return by 223.1%, while they escalate risk only by 42.2%. So our risk goes up about 4.2%. However, our return goes up more than 223%. So what do you think? You undertake additional risk by 40.42%, and you receive additional return by 223%. So the risk versus the return versus risk is 4.32%. This is the Sharpe ratio, which is the highest one, right? And GMVS now has the lowest one. So from this way, we think MSR strategy is the best one for prudent investors. Right? Okay. So from this table, we can find out more characteristics about MSR. Yeah. Okay. Well, for real investment, I'm not sure whether EQ could be still here, or OM cap should be still here, or GMVS should be still here. But usually MSR will be number 1. That means by MSR strategy, we escalate our risk by a small portion, but we escalate our return in a much bigger portion. That's the core idea of MSR strategy. So in order to describe the effect of MSR, let's have a simpler table on this. This is return, this is risk. This is GMVS, and this is MSR, and MSR versus GMVS. So compared to GMVS, MSR's risk escalate additional 15%. However, its return escalates more than 159%. Okay? So this is the power of MSR, right? You may be very curious about the portfolio proportion of MSR. So which stock should we hold more? This is the investment portfolio of MSR. Now it's the date to make this analysis, which is 2021, July the 7th. It's the observation period here. We have we use a 1-year observation period. Now, after a while, we will do this case by our own. Together, we can set our observation period from probably for a longer period. For example, we start from 2021, January the 1st, and to 2022, July the 26th, means yesterday. Okay. So under MSR strategy, which stock should we hold most? We find that by this period, our best strategy is to hold 9/9 by 42%. Wow. Not multi. And 水井坊 by 35%. This is after optimization. 三席分酒 10%. And 口之教 4% more. Multi only 2%. Why is very interesting? Why multi is at a much smaller proportion? Probably we think multi stock price is too high and it's too risky already. And 古井贡 only 1% more. 泸州老窖 1%. 五粮液 well less than 1%. But in reality, we should actually remove this stock from our proportion and do again, because this indicates we don't need, it is not a good idea for us to hold 五粮液股票, right? We can remove it and leave the others. So actually, for these 1%, we can also remove them. So after removing these low proportion stocks, we may have a higher return. Okay. Now, it's time for us to do the case together. This case is a little bit longer, and we may take more time to do it. Now, let's do it one by one. In order to do these case studies, we have many steps. Let's do the first 3 steps. Step 1, we define the current portfolio. Okay. First code, we specify our stock market. So we use a variable here. We have a keyword here, market. We use market in China, and we use the market index. This is the Shanghai Composite Index, right? This is the Shanghai Composite Index. Well, if we use stocks in US, we should change here to US and change here to probably either a Standard & Poor's 500 or Dow Jones, for example. This one for Standard & Poor's 500, this one for Dow Jones, right? And if you expect to use Nasdaq Composite Index, it would be this one. Yeah. And step 2, we define current portfolio. It's member stocks and weights of shares. That means the proportion. Okay, we have another variable here. Okay. Now, please notice we use this bracket. The first one is multi. 0.4 means we have 40% of them. next 20%, 10%, 10%, 8%. Well, all these together, I suggest all these weights together, the lump sum should be 100%. I strongly suggest that. And step 3, we finally construct the current portfolio. Okay, now we have the variable portfolio and we have the dict. Dict is a Python keyword, means dictionary. It's a Python data structure. Okay, market here comes from here, right? And stocks come from here. We have 2 asterisks here. So by this way, we can define an investment portfolio. It's an investment portfolio. Now we can call it portfolio. Of course, you can just define it as A or B or C or 张三or Li Si, whatever. And in this investment portfolio variable, we can find out many information. First, the security market is either in China, in US, or China, Hong Kong. Okay, if you use the stocks in China, Hong Kong, please use China, Hong Kong here. And also the portfolio members, also the proportions of each members here, right? Let's do it first. Okay. We copy these commands to our Jupyter notebooks. Okay, we have step 1 here. Here. So step 1, we define the stock market as well as what? As well as market index, right? As well as market index. And then we define the stocks and the weights of shares. It's actually portfolio members. Okay. 1, 2, 3, 4, 5, 6, 7, 8. Yeah, we have 8 portfolio members. You can specify any weight of shares at the beginning. Please be aware, the lump sum of all these weights of shares should be 1 or 100%. Then we define the portfolio by this way using Python dictionary. Then we execute. We find something wrong. Yeah, this is not correct. Delete. And then this way. Okay, I believe it resolves the problem. Okay, nothing to say means everything is okay. Then step number 5. Let's compare the current portfolio with 2 simple strategy, equal weight and OM cap. Suppose it is the date 2021, July the 7th. And we use the data of recent 1 year. Well, we may use the most recent date, right? Step 5. We may use the most recent date. July. The data available to us is up to yesterday, so we use 26, right? And we still use a recent 1 year data for the observation period. If you expect to use 2 years, okay, change here to 2. But usually, by default, we use 1 year. We are looking for the information of all these portfolio members. We look for their information from internet. Wow, this is the, okay, it generates lots of information, right? First, it's the daily return. It's the daily return, right? And for the daily return, difficult to see useful information. Very difficult to see that. So in order to compare our investment return, we use the holding period returns. Okay, this is the holding period returns of our current portfolio. Okay, probably I think we can have a name. We can have a name for the investment portfolios, right? So what is the trend of the investment portfolio? For the current situation, it is like this. That's the situation. Then let's compare the current portfolio with two simple strategies, equal weight and OM cap. This time we find they are quite similar to each other, right? So this one is the equal weights, right? And this one is the OM cap. And this one is the our current portfolio. Okay. So even we look at the situation yesterday, means 2022 July 26. Our current portfolio, their performance is better than that of the equal weight portfolio and the OM cap portfolio. Right? So this is the case. But do we still have necessity for further improvement? For further improvement, it means we expect to look for higher return. In the meantime, we do not expect to escalate our risk too much. So we look for a higher Sharpe ratio. Okay. This is our step 5. And then step 6. Step 6, we expect to construct efficient set. We will use Monte Carlo simulations. And this time we use 50,000 times of Monte Carlo simulations. Of course, you can change all these things if you have a powerful computer. And these are the portfolio constructions. Okay. Here we use 50,000 times of Monte Carlo simulations, right? And the PF here. Okay, so we have a variable called PF here to store the information returned by this Python command. And this Python command called portfolio HPR, holding return. It means it will draw the portfolios, their holding returns described by this variable. This variable describes the investment portfolios constructed here. Okay, and compare with two common, very simple investment portfolio strategies, equal weight and OM cap. So the result is here. And this is our current situation about the investment portfolio. Our current one is Maotai, 40%, 五粮液 20%, 五景贡 10%. Okay. And about our equal weight, we will hold each one by 12.5%. Right? Because we have 8 shares. We have 8 shares here, and the total should be 100%. And 100% divided by 8 is 12.5%. So this is called equal weight. And then next is OM cap. OM cap, the percentage is by their market shares. So suppose this is the portfolio value. We have a portfolio value here. Market value of this portfolio. Suppose this is 100. Okay. Multi is 34.92%. This is the highest one. We know that for market capitalization, this is the rank multi. Next is Wu Liangye. Wow. Wu Liangye's market capitalization is also very big. 26.08%. Next comes with Luzhou Laojiao, 12%. Sanxi Fenji, 10%. Jiu Guijiu, 7%. Kouzhijiao, 3%. Shuijingfang, 3%. Wujinggong, 2%. Now we know the biggest market capitalization in China Baijiu industry. The two biggest one is Maotai and Wu Liangye, right? Maotai and Wu Liangye. These two stocks has the biggest market capitalization in stock market in China. And this is their comparison about that. You can look at this later because it is too big. We can shrink this. Okay. Yeah, it looks better now, right? So this one is our original portfolio. And this is equal weight. And this is OM cap. We find that, of course, for highest return, our original one is the highest. And for risk, our original one is the lowest. So among these three portfolios, our original one is already the best. With return number 1, risk number 3, highest return and lowest risk. So we take this as a base. And when we look at OM cap here, it's now sorry. Okay, 2022 July 26. This is our anchor date to do this analysis. And compared to this one, we find that OM cap's risk increased by 2.7%, while its return decreased by 26%. So compare the base one, this portfolio is not meaningful, right? And this one, let's look at this one, the equal weight one. Compared to base, its risk increased by 6.8%. However, on one hand, their risk increased. On the other hand, their return decreased by 184%. So this is meaningless. It doesn't make sense. So compare these three portfolios. We will keep this one as the base. Next, we try to find better one. Okay. Probably this one. In order to construct the efficient set, we use Monte Carlo simulations. And we will do the simulations for 50,000 times. Of course, you can do more times, provided you have a more powerful computer, because it takes a lot of time. And this command, portfolio ES, efficient set, means constructing portfolio's efficient set. The results will be stored here, and next step we will use the results. Okay, the first parameter is the variable we get from the first command, the command just now. Let's do it. Although it takes time, we have to do it, right? Probably we can do less times. Okay, now it's calculating. And we will have a progress bar here to show us what is the status nowadays. Okay. It's still in progress. Okay, now it's already 10%. When it goes 100%, it is that. So let's wait. And in the meantime, let's have a 10 minutes break. See you after the break.